Well, open interest is one of the main metrics that I follow. It shows how many people have bets open either on the long side or short side. They always equal each other out because every long is a short. How many of those contracts are open? So how much notional value of gold is being traded at any one time? And the lowest that we've gotten post 2008 itself, the dip of that crisis, I think it went down into 300,000s, maybe in the high 200,000s, if I remember correctly. I don't remember exactly. But the lowest that we've gotten since then has been about 400,000. And we're just above that now at about 450, 460, something like that. And that's a very low number. Before this rally, you could say it started in January, February. If you look at the interplay between price and open interest, usually they go up together and down together, and then open interest resets, and then you start another rally. It's like, a ratchet. So the price keeps going up, but as it goes up, open interest goes up, and then open interest goes down again, and the gold price goes down a little bit, but then ratchets up again to go higher. It's that sort of movement. And so when we see something like open interest falling, 100,000 contracts, 150,000 contracts, I don't know exactly how much it's fallen since January, it's something around there, but the price going higher anyway, that means that the shorts are closing their contracts, they're buying back their short positions, either with dollars or with deliveries. Right? They can close their contracts by delivering gold, and their dollar positions don't really change. So that's what the bullion banks do. So that's how they hedge, right? So if they're short a contract, doesn't mean they're shorting gold outright. It means they're shorting the futures, and then they bought the physical somewhere. And I think that's where the deliveries come in, right? It's the bullion banks that are delivering gold into their short positions so that it doesn't really affect their accounting. They can do that as long as there's enough gold to do it, and so far there is. So I think the fact that open interest is so low, and a lot of it is down because of these deliveries, every time a contract is delivered, that open interest is erased. That means that the amount of speculation in gold futures now, not for delivery, but just to speculate on the price, is very low. Otherwise, open interest would be higher. And because it's so low, that means that there's room for it to move higher, because the speculators that drive price on the margins are not in the market right now. They're gone. I think they were in a little bit when we hit 3,500, but even then, open interest was still pretty low. I mean, we can get as high as 600, 650,000 before it really gets into the nosebleed section. The highest we ever gotten was right before the 2020 COVID crisis. I think around January, February 2020, it was like 850,000. That's abnormal, but a high number would be around 600,000. We're nowhere near that. There's plenty of room to run in the rally. So then I would say, for that reason, that if there's going to be a further sell-off in gold, it will either be shallow in price, meaning it won't go much lower than it is now, or, you could have a very brief blip. I don't know, I'm just saying a number just to pick a number, 3,000 or whatever. Which used to be, a big high watermark a few weeks ago, and now it's like, oh my God, 3,000, gold's crashing. So, everything's changing so fast now, and our mortality can't keep up with the reality. Yeah. So that could happen, but if it does happen, that would be the bottom, and then we'd be on our way up. So either short in any continued correction for would be short in time, or shallow in price. That's what I would speculate.
Open interest is one of the most important metrics I follow when I analyze COMEX futures. It tells you how many contracts are open, how many bets are still on the table. It doesn't tell you direction, because for every long, there's a short. But what it does tell you is how much speculative firepower is left in the system. And right now, that number is low, very low. Before we go further, let's define what we're looking at. Open interest is the number of active contracts that haven't been closed or delivered on. It's how much notional gold, paper gold, is still in play. Historically, during strong bull moves, price goes up and open interest goes up with it. Then at some point, open interest resets, it drops, and price consolidates. That's your classic bull market ratchet. Push higher, cool off, reload, push again. Now here's the setup. Open interest in gold right now is around 450,000 contracts. That's not just low, it's brushing against post-crisis lows. The last time we were meaningfully lower was 2008, right in the teeth of the financial collapse. Since then, it's hovered in higher ranges, even during pullbacks. But now, after this recent rally into the mid-3000s, open interest is still stuck in the low 400s. Let me translate that. Speculators aren't in the market. The people who chase price, the funds that get in late, they're sitting on the sidelines. That means this rally so far has been driven not by hot money, but by shorts covering. That's a huge deal. Here's how I see it. When you see price going up but open interest going down, what does that mean? It means people are closing contracts, and that usually means the shorts are buying to cover. They're getting out. They're cutting exposure. They're not adding to positions. That's not bullish in the short term. It's explosive in the medium term, because when the shorts are gone, all that's left is upside. Let's be clear. These aren't just hedge fund traders on the short side. A lot of these positions come from bullion banks. They operate differently. They'll short the paper and hedge it with physical. They'll take a short position on COMEX but hold bars somewhere else, maybe in New York, maybe in Zurich, maybe unallocated in London. So when it's time to deliver, they can cover their short with real metal and their dollar exposure stays flat. It's a hedge, but it's fragile because it assumes the bars are available, deliverable, and not being pulled into Asia. So when open interest drops during a rally and those short contracts are being closed through delivery, it means the bullion banks are managing exit risk. They're trying to close out their exposure before the speculative demand comes back in, and that's exactly what we're seeing now. Now let's step back and add perspective. The highest open interest ever recorded was in early 2020, just before the COVID panic. It hit 850,000 contracts. That was the top. The nosebleeds, the froth, were nowhere near that, not even close. A more typical high would be in the 600,000 range, and we're still 150,000 below that. So where does that leave us? It means the price rally has legs, because once open interest resets and the weak hands are out, that's when new money flows back in. You can't go higher sustainably when you're already over-leveraged. But when you've got a clean slate, that's when the slingshot gets pulled back. Now let me address the emotion in the room, because gold just had a wild move. We saw it hit $3,500. Then it dropped back to $3,200. Then again under $3,100. Everyone freaks out. Is this the top? Is the rally over? But let's stop and actually measure this. A $300 drop at $3,500 is about 8.5%. That's barely a blip in a real bull market. We've had days in the S&P that were worse. But because gold feels slower, people forget how volatile it gets near the end of a base breakout. So if we see a further correction, I'd call it a gift, because we're already near a reset level on open interest. And once this is done consolidating, whether that's at $3,000, $2,900, or even where we are now, the structure says it goes higher, not eventually, soon. Because what we're seeing now is a very rare thing, a rally with no speculative froth, no euphoria, no CNBC coverage, no buy gold articles on Bloomberg, just steady accumulation, silent short covering, and declining paper exposure. It's almost boring, and that's what makes it beautiful.
I don't know if delivery has anything directly to do with the amount of gold on the exchange. You'd have to actually take it out. Because delivery, I mean, I've done delivery before. I've gotten physical delivery, but the word is kind of false. It's not physical delivery. It's sort of physical delivery in the sense that you have, instead of the notional right to, let's say, 100 ounces of gold in the ether, you have a right to one specific 100-ounce bar, which they could say, well, it's that one with that serial number, so there's your physical delivery, but you can't get it unless you are you have like $1 million in liquidity and you have special permission and you're connected to a bullion bank or whatever it is. It's possible. It's just not for retailers. The physical delivery has to do with warrants being exchanged. It doesn't have to do with gold leaving any of the vaults. But that could happen. I mean, deliveries could correlate with the supply going up or down. It just doesn't have to. So right now, what I've seen is that the gold supplies, meaning the amount of bars that are in either eligible or registered, they hit a high mark. I think it was like 42 million ounces, maybe 43, something like that. I could be off by a few million, but the point is, wherever it is, it's been edging down slightly now. So either they're being pulled out of the vaults or they're going back to the UK or to Switzerland. I don't know. Looking at that directly right now, I was curious because I wanted to see how high they would go, and I think it has to do with tariffs. Because in the atmosphere of uncertainty, nobody knew for sure if gold bullion was going to be tariffed. So if the bullion banks were going to be forced to close their short positions through delivery, like they had a risk, right? If the price is going to go up and they couldn't satisfy it through delivery without paying like a 25% tariff or whatever, then they'd be screwed. Basically, they wouldn't be able to save their dollar positions through delivery. So they had it front loaded and just brought to New York beforehand. But now that bullion isn't going to be tariffed anyway, it doesn't really matter. So it'll probably head back from here. If they can get reassurance from the Trump administration that he's not going to mess with bullion, which I don't know. I don't know if you can count anything as reassurance from the Trump administration, and I never did before. So now I pay them. Okay. I looked at their list of countries, the top 15, 20 bullion holding by central bank, and China was in there. And the only ones that I saw that are buying gold right now, of course, I don't know. The data is only good through Q4 of 2024. So it doesn't account for the rally from February to now. So anything could happen. Nobody has that information yet. And when we have it, it'll be incomplete. But what I've seen is that the two central banks that are buying the most are actually Poland and India. So India has been buying consistently, and Poland as well. Now Turkey has also, they've been up and down. I think they're at a new high in their gold holdings, but they buy and they sell every month depending on what their currency does or how desperate they are. So I don't really rely on them.
Let's keep going, because where this story really gets fascinating is in what happens after this reset. We've established that open interest is low. We've covered that speculators aren't driving the rally yet. But when they come back, because they will come back, they'll be doing it into a very different market. And here's what I mean by that. The physical gold market is getting tight. And I'm not talking about $5 over spot or some retail bullion delay. I mean tight at the institutional level. Vault inventories are not expanding. If anything, they're drifting downward. You're seeing increased premiums on large bars, and more importantly, you're seeing ETF redemptions starting to flow away from traditional custodian routes. That's the tell. Because when the gold price is rising and ETFs are losing metal, what does that mean? It means that big players are using ETFs like GLD not as an investment vehicle, but as a conduit to remove metal from the system. You short the ETF, redeem the shares, take the bars and move them off grid. This is not speculation. This is extraction. And here's where it ties in with open interest. The fewer contracts outstanding, the fewer claims remain. So as open interest drops, and as ETFs are drained, and as vault inventories decline, you're left with less paper and less metal. That's the powder keg. Because when the price starts rising again, and it will, speculative capital will return, funds will chase price, managers will respond to performance pressure, and they'll start piling in. But there won't be any metal left to settle with. And that's the crack in the system. That's when someone stands for delivery and gets cash settled. That's when the illusion becomes obvious. And that's when the whole world suddenly remembers that paper gold is not gold. It's a claim, a promise. And in times of crisis, promises get broken. You see, the price of gold is not just a function of monetary policy. It's a function of trust. When you trust that you can always convert your claim to metal, the price stays orderly. But when that trust gets violated, even once, the paper system collapses. Now, this isn't just speculation. We've seen precursors. In March 2020, when the COVID panic first hit, there was a sudden disconnect between COMEX futures and London spot. For a few days, gold traded at a $100 premium in New York. Why? Because there wasn't enough metal in New York to meet delivery, and they couldn't get bars flown in fast enough. So the futures price unmoored. That was a warning shot. And nothing has changed since then. In fact, the system is even more fragile now because more metal has quietly left Western vaults. More contracts have quietly closed. More risk has quietly piled up. And then there's the dollar. This is the part no one wants to talk about. The dollar structurally is in trouble. The US is running $2 trillion annual deficits at 5% rates. Interest payments alone are over $1.2 trillion a year. That's more than defense, more than Medicare. It's the largest budget item, and it's growing. The only way out is to monetize, which means QE, which means inflation, which means currency devaluation. Now, in that environment, where do you go? Bonds, number stocks? Maybe for a time. But when real yields go negative again, and they will, you go to hard assets. You go to gold. And here's where we tie it all together. If gold rallies with no speculative fuel, and if the paper markets are tightening, and if the dollar is structurally deteriorating, then the next phase isn't a rally. It's a repricing. And that repricing won't happen in dollars. It'll happen in behavior. Because the moment a futures contract can't be delivered, the psychology of the market changes. Gold is no longer just an asset. It becomes a liability to be settled. And if it can't be settled, people panic. They'll pay anything to get out of paper and into physical. And that's when the system snaps. But there's one more piece, and it's the part no one is prepared for. The central banks? They won't help. They'll be net sellers, not buyers. Why? Because when their currencies come under pressure, and they will, they'll sell gold to support the illusion. They'll throw away their reserves to buy time. But it won't work, because the public by then will know what's real. And they'll stop accepting currency promises. They'll demand settlement in metal. And that's when gold leaves the system. It doesn't go back to vaults. It doesn't get redeposited. It gets privatized. It goes to the people who saw it coming, the people who took delivery early, the people who didn't trade futures. They held ounces. And that's where it ends. Because once physical gold is widely understood to be superior to fiat, the monetary game is over. Governments will scramble. Central banks will revalue. There will be a new system, but it won't be built on trust. It'll be built on weight, Massachusetts purity, provenance. And the people who get there first, they won't care what the COMEX says. They won't care what the ETFs print. They'll hold real money, and that's what this rally's about. It's not about price, it's about escape velocity. And let me say this, what people call a gold rally right now, it's not really a rally. It's a repudiation, a quiet refusal, a system unraveling in slow motion where the smart money is not trying to profit, but to exit. If you're still thinking in dollar terms, in price targets, 3,500, 4,000, 5,000, you're still in the illusion. Because what's happening here is not just gold going up, it's everything else losing credibility. One asset is exposing the others. That's the key shift. And that shift won't reverse until people stop asking, how high can it go? And start asking, how do I get out of the paper before the music stops? This brings us to a broader economic question, and this one runs deep. What is money? Most people think it's currency, digits in a bank, or green paper backed by men in suits. But real money is something else entirely. It's trust, distilled over time. It's energy stored. It's savings that don't decay. That's what gold is. And the more this current system cannibalizes itself with debt, dilution, and devaluation, the more people will naturally gravitate toward the only thing that still fits that definition. We're watching the final chapters of a fiat experiment that's lasted 50 years. And as always, the market is front-running the consequences. Watch what's happening in the repo market. Hedge funds running basis trades, leveraged positions exploiting the spread between futures and cash treasuries. These trades require liquidity from the big banks, and those banks are getting twitchy. Why? Because the collateral underpinning these trades, US debt, is no longer considered risk-free. The moment the Fed loses control of the long end of the curve, those spreads go haywire. And when that happens, you get forced liquidations, followed by a stampede for anything that's not someone else's IOU. And this brings us back to gold again, not as a commodity, but as a clearing mechanism. When confidence breaks in financial assets, capital doesn't go to yield. It goes to settlement. What's the one asset that can settle trades without counterparty risk in all jurisdictions, at all times, without a printing press or a balance sheet? Physical gold, not futures, not ETFs, not options, just metal, in hand. The monetary system that follows this one won't be built in a boardroom. It won't be voted on. it will be discovered, like gravity. Because once the need for honest settlement becomes universal, gold simply reappears. And it doesn't need permission, it just needs demand. Every collapse in financial history, from Rome to Weimar to 1971, ends with the same result, a return to something real. This time is no different. The only question is whether you're early or late.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.